Hi everyone, welcome to today's session hosted by Angel Broking and Smallcase. In today's session, we have Estee Advisors, one of the prominent small case managers on the platform. So to give you a quick introduction of Estee Advisors Private Limited is one of the leading names in the quant-based investment management space, which was founded by Mr. Sandeep Tyagi in 2008. Gulaq is the investment advisory arm of Estee Advisors, focusing on creating model portfolios for the mass retail market using a well-defined algorithmic process, which are backtested and rebalanced monthly. So, to give you an introduction of both the speakers who are present here today, we have Sandeep Tyagi, who is the founder and CEO of Estee Advisors. So, he holds his bachelor's from Indian Institute of Technology, Delhi, and his MBA from Columbia Business School. He has 30 plus years of work experience in portfolio management, analytics, and consulting. To give you an introduction of Vivek Sharma, who is the Director of Strategy here at ST Advisors, he holds his electrical engineering from IIT Kharagpur, and he has 18 plus years of work experience in portfolio management, investment management, and trading. So without further ado, I would request both the speakers to maybe share with us their investment philosophy, how their philosophy has worked out so far, and to throw some light on what the experience has been so far and maybe enlighten us with any more details that you would have to offer to us today.
Thank you, Pranav. Hello everyone. I'll be talking about our product offerings to begin with. So we have actually divided all our portfolios in terms of different risk profile for different risk profile of customers. So for aggressive customers, we have two portfolios by the name of Gulaq Wealth and Gear 6, which is 100% equity. Then for moderate investors, we have Gulaq Gear 5, which is 80% equity and 20% debt. And for conservative investors, we have Gulaq Gear 3, which is actually 60% debt and only 40% equity. Right. So we launched these products in May 2020, and you can see that since then we have been able to beat the benchmarks convincingly for on all of these four portfolios. So here's the live performance of Gulaq Gear 6 since May 2020. And you can see that the equity multi-cap has also done really well. It has given 94% returns since then, whereas our portfolio has done almost double of that, which is 180%. Right. So this shows the power of our actually multi-factor models that we have used while creating these strategies. Again, in last 6 months, we can see because of the headwinds due to Russia and Ukraine crisis, we have seen markets correct a bit. So in last 6 months, we have seen markets go down by roughly around 3% or so. This is for BSE 500. Whereas even in these times, our portfolio has been able to do well and has returned positive 13% alpha in these markets, right? Now here is the performance relative to the benchmark. So if you go to the platform, you will see Gulaq Gear 6 and Gulaq Wealth, which are compared to BSE 500, which is a fair comparison because both of these have 100% equity. So that's a fair comparison. But Gear 3 and Gear 5 are also compared with 100% equity, which is not a very fair comparison. So in this slide, what we have tried to do is compare Gear 3 and Gear 5 with their respective benchmarks, which is actually Gear 5 is 80% equity and 20% debt. So we created that benchmark, and if you see relative to those benchmarks, Gear 5 has also done about 25%, whereas the benchmark is closer to 15%. And for Gear 3 also the benchmark is closer to 10%, whereas we have been able to do better than that with 15% returns. So overall, all our portfolios have been doing pretty well for the last 2 years or so, right? Now, I would like to cover Gulaq Emergency Fund, which we just launched a couple of weeks back. And what we have seen is post-COVID crisis, we have seen a lot of people actually realize the importance of emergency fund. So till maybe prior to that, people used to save that money maybe in equities or anywhere, but they didn't have a specific emergency fund for their needs. And we have seen a lot of demand and people are interested in this kind of a portfolio. So this is actually nothing but 80% debt and 20% equity. And why we have kept 20% equity is we have seen a lot of options which are there out there for emergency fund, which is essentially debt. They are many times they are unable to keep even with the inflation. So even though you're saving for emergency, the value of that fund is actually going down uh, if you consider inflation. So that's why we have kept just 20% of the part as equity in order to so that this fund is not is able to beat that inflation over longer. And in this, the way we have created it is we have tried to keep really low minimum investment size so that people can get started very easily. Here it's close to 1200 rupees is the minimum investment size, and even the fees for this is pretty low. It's rock bottom at 100 rupees for 6 months. So uh, our idea is maximum people should be able to utilize this specific portfolio in order to fulfill their needs regarding investing in an emergency fund. Uh, Next, I'd like to cover a bit about how, if you are a investor and you're just getting started with investing, what are the important things for you? Because there's so many products out there, there's so many ways of investing that it can really get overwhelming for new investors, right? So we believe that it's a relatively simple process. What anyone should do to begin with is there are a lot of risk profiling questionnaires out there. If you just go to Google and search for risk profiling questionnaires, you're going to get tons of results out there. And first thing that you should do is take that questionnaire, and what that tells you is how much of a risk you can bear in the markets. So the questions are based on following factors: that what's your age or your past experience with investing products, or how you react to losses when they do occur in your portfolio, or the time frame of your investments. So around these questionnaires are formed, and it's a most of them are pretty simple, straightforward. You can just take it in a couple of minutes and you'll get to know uh, how risk tolerant you are. So the output of that is mostly in the terms of whether you are an aggressive investor, which means you should have much higher allocation to equity and a smaller allocation to debt. Or if you are a medium moderate investor, which is kind of somewhere in the middle, have kind of roughly equal or thereabout asset allocation towards equity and debt. And if you are a conservative investor, then you should have a smaller allocation to equity and a larger allocation to debt. And after identifying what's your risk tolerance and how much equity and debt allocation you should have, you should just try to invest as per this allocation and just try to see that whether you are able to maintain this allocation or not. That's the only thing you are required to do, irrespective of whether the markets are overvalued or undervalued. If you just follow this simple philosophy of maintaining your asset allocation, your life becomes easier and you will be able to maintain that discipline which is required for creating long-term wealth. Uh, in this, what you should also consider as an investor is most of the times we just look at the returns while trying to evaluate an investing opportunity. And if you are just looking at the returns, we are just looking at half part of the equation, because the other part of the equation is the risk part. So obviously, the higher returns come along with higher risk. And if you are, say, a moderate investor, but looking at the returns, you have invested in a much bigger part of your portfolio in equities, what is going to happen is till the time markets are going to go up, you're going to realize these good returns and you're going to be happy. But when markets start sideways or when they start correcting, you're going to see good drawdowns in your portfolio. And if you are a conservative or a moderate investor, you won't be able to bear those losses, right? And then what happens is you most of the time make mistakes of getting out of the equity markets or making wrong decisions, which actually stops the compounding process. And what that actually, the impact of that is you are unable to actually get back into the market when they start rising. So you keep making those kind of mistakes. If you have taken exposure to a higher risk portfolio, And that is one thing that we should all avoid. So based on your risk profile, you should just select the portfolio, select the asset allocation and stick to it. That's how investors should be investing their capital. Right. Next, I'd like to invite Sandeep to talk about our company, about our vision with Gulaq and our portfolio construction methodology. Sandeep, over
Thank
to
you.
you.
Thank you, Vivek, and thank you, Pranav. First of all, thank you to Smallcase and Angel for inviting us to talk about our products and our company. I want to start by just telling you a little bit about the overall company and our processes. The company was started in 2008, and in that year, as you would remember, there was a big correction in the market. I had just gone from my previous company, which I had sold and it had gone public. And I had seen my own net worth drop by more than 50% in the 2008 correction. So the idea for the company was there's got to be a better disciplined way of keeping and growing your money. All of us spend a lot of time figuring out how to make money, whether it is in job or in business. But we also need to learn how to keep and grow that money. And that's also a professional full-time task. So I decided to create a company which will be based on the principles on how to do that with discipline systematically. So today the company has more than 125, almost 135 professionals, which have strong quantitative finance technology backgrounds. We run one of the largest arbitrage funds in PMS space by trading volume, which has worked for last about 13 plus years and never had a losing month. So every single month, quarter, year has been positive. We also were awarded the NSE Institutional Member of the Year because of the amount of volume and trading we were able to do through our brokerage firms. We do have products which cover emerging markets. So we have a similar capability in terms of investing in Brazil, in South Korea, in Hong Kong, in China, in even in United States. So our capability transcends not just India, but several other emerging markets. Talking about Gulaq, which is the set of products that Vivek just took you through, Gulaq is our retail advisory arm. So all this institutional capability that we have built over the last 14 years, we thought, what is the best way for us to bring it and make it available to a single retail investor, somebody who's probably not looking at a portfolio of 50 lakhs or a crore, which is what is needed for an AIF or a PMS product, but can start investing with few tens of thousands or lakhs of rupees. So we took the same technology that we had built for investing larger amounts, which is a systematic quantitative approach, and simplified it and made it appropriate for smaller portfolios. We also got registered as an investment advisor, and putting together the regulatory framework as well as our methodology, we are able to create a set of products, which is what we are talking about, which are available to you now through your broking and platform, as well as through the Smallcase partnership that we have. Moving on to the next page, I want to talk about the investment process itself. How is it that we are able to create these portfolios that Vivek just talked about, which have performed well, which have done better than index? How do we make it happen? The first step is we've got to understand what is the idea based on which we are going to say something is a good investment. All of you have hypotheses. You may have it that your good friend told you that this is going to be a good stock. You saw it on a WhatsApp message, or even you saw it on CNBC, or maybe you like the name, or some people believe in other kind of indicators like this numerology or whatever it is. But there is some hypothesis saying this is what's going to be a good investment. We take all those hypotheses as the first step. And then what we do with it as the second step is back testing. Backtesting means you look at the actual historical data of last 10, 15, 20 years and see whenever this particular idea happened earlier, what was the actual return? It's not the first time. If you believe that something that has gone up for last 2 weeks will continue to go up, that's called momentum. That's a hypothesis. And you can test it. How many times has it happened that the stock has gone up for last 2 weeks and it then continues to go up in the third week? When you test it, you will find out, is it a good hypothesis or not a good hypothesis? That's what it means to have a systematic hypothesis confirmed with backtesting in actual historical data. Once you have done that, you come to the third step, which is building an automated engine. So you combine a lot of these hypotheses which have been backtested and put it into an automated engine, which is continuously scanning all the data that is available, and then making a decision on what to buy, what to sell, when to go into a particular position. The final step is a risk layer where we look at our limits. What should be our concentration in a particular stock? What should be our concentration in a particular sector? How much should we worry about the volatility of an individual stock? Some stocks have what is called high beta, which means they move a lot. They can be up 10%, they can be down 15%. Some stocks are very stable. They go up a couple of percent, go down a little percent. When you build a portfolio, you have to make sure that these are balanced. So risk management layer is also very important. Now I'm going to take you through a little bit more detail how the process works. These are the building blocks for our strategy. The first building block is called the dynamic factor combination. What that means is each factor is a fancy word for saying what is your basic hypothesis on something will go up or down. So if I say the price has been going up for last 2 weeks, that means it will go up again. That's a factor. That's momentum. If I believe that the low PE stocks will outperform because they are being valued cheaply, that's a factor. It's called the value factor. If I look at something like their cash flow or volatility or their debt to equity ratio, each one of this is a factor. They can be fundamental factor, which means they come from their financials, or they can be technical factors, which means they come from the market action. That what is the volume on it, how much call or put have been put on those, what has been the recent price action on it. All of these together are called factors. So we put them together and we call them dynamic factor combination. Dynamic means what weight is given to each factor is decided based on what is happening that time in the market. I'll talk about this a little later on again. The second building block is index reconstitution. Index in itself is a very important market demand driver. Why? Because many large investors get exposure based on index. They simply buy Nifty. You know, Nifty as a product is, as a derivative, as a future, is a huge market. So a lot of people take market position based on the whole index, which in turn has an impact on the demand for everything that is part of that index, like Nifty 50 or Sensex or Next 50 or BSE NSE 500. All of these have their own constituents. And whenever there is a stock enters an index or leaves an index, it makes a big difference to its demand in the marketplace. The next building block is institutional holding. All of us know that there are lots and lots of very, very smart and large investors in the market. What if we were able to understand what is being bought by different investors at a given time? Of course, we hear about it on CNBC all the time. Such and such large investor has bought this stock, or this is the action they are doing. We do it at scale. We look at every mutual fund. We look at foreign institutional holdings. We try to understand what is it that they're buying, what is it that they're selling, and we aggregate all of that information to give us a sense of what is the demand from institutions for each of the stocks that we are evaluating. The next building block is the sector industry rotation. As you would know, given what's happening in the economy, certain sectors or industries will do well. Sometimes we have a belief depending on where the rupee dollar is, that the export-led sectors will do very well. Sometimes we have a belief if the agriculture, for example, is doing very well, that the consumption sector will do well because people will have a lot of money, they'd be able to buy things, or the infrastructure sector, or telecom, or commodity-led sector. So depending on what's happening in the macroeconomic environment, certain sectors or industries can do well. We look at the factors which may impact each of the sectors and then try to decide how we should position our portfolio. Now, this is independent of what we think of individual company. When the whole sector does well, each company will have some positive benefit from it. So we look at this sector factors independent of what we do with the individual company factor. The last building block is market microstructure. Here we are trying to understand what is actually happening with things like when something goes in ban, something is being demand and supply, the how its various products are performing, whether it's in the derivative segment or other segment. We put it all together in this bucket called market microstructure, which understands the actual trading activity and product activity on individual stock. When we put all of this together, we come up with over 130 micro strategies. Now, each strategy here in itself could be a viable investment method itself. For example, there are lots of funds and strategies out there which simply do momentum investing. That would be one of the strategies for us. Or it could be value-based investing, which would be one of the strategies for us. So we have built 130 of these micro strategies across these building blocks, and we put them all together. And then the next step for us is to combine them and then build a multi-library signal, which we are trying to prioritize which of the regime is there in the market today, and therefore which of these signals should be given what weight. This is the method by which we take these building blocks, 130 micro signals, and put them together into a single portfolio. So the regime estimator is important. That's about 9 factors on where the economy is. What is our inflation rate? What is the US dollar rupee rate? What is happening with the oil prices? What's happening with the trade imbalance or interest rate curve structure? All of these give us an indication of what regime we are operating in. When we look at that, we are able to get the portfolio and put it into the Gulaq portfolio. Now, the risk element that I talked about also comes into play at this stage, where we are obviously putting limits. You know, what is our single stock concentration? What is our sector concentration that we are going to allow? And what is our overall volatility expectation? So we are not putting a lot of volatile stocks into the portfolio as we build the overall composition of the portfolio. Hopefully that has given you an overall sense of how our methodology works in terms of creating a science-based method of investing. We do not have any process in which we follow tips. We do not try to incorporate things like, what a management interview would do. What is our gut feeling about what would be the talent of this company? We focus on things which we can systematically study over many years and then decide whether we are going to use that in terms of determining whether to invest or not. That kind of concludes the description of our method and our company. I'm going to turn it back to Vivek to take you through how you can try it out, take it for a test run, and see whether this methodology and process is something that meets your investment and savings needs.
Thank you, Sandeep. So here, to begin with, we have come out with a special introductory offer, especially for angel brokerage clients, in which we are introducing, giving a discount of 20% on all our portfolios, and the coupon code is Angel20 for the same, right? Next, I'd like to take you through the specific angel broking platform and show you around how you can maybe search for our portfolios and do a comparative analysis of how we stand versus the other competitors. So the URL to access this platform is smallcases.angelbroking.com, right? When you log on to this specific platform, you go to this discover link, and there are two tabs here. One is managers, which has all the information about the managers which are listed on this platform, and then the portfolios which are under all small cases section. So let's start with our portfolios. And as I've talked about these portfolios for specific risk profile of customers, let's just see that. So let's say we take all the portfolios which are there, the fee based and the free access, and we have tried to create these portfolios for investors who are just getting started with. So we have tried to keep our minimum investment size lower to the extent it was possible. So if you just look at under 50K, and let's sort them by their returns, say 6-month returns here. So if you see for an aggressive customer, which will have a higher volatility portfolio, you can see our portfolio, at least in the last 6 months, have done phenomenally well, and we are in fact #1 here, right? Again, if you are say a medium risk customer and want to invest in a medium volatility portfolio, you can just click on the medium, and even here our Gulaq Gear 5, which is coming under the medium volatility category, has been doing pretty well, and we are still #1 here as well. Now, for the conservative investors, we have uh, a portfolio in low volatility, but that is over 50,000. So here, if you see, we are again in top 2 here. Gulaq Gear 3 is the second ranked of all the small cases which are listed on this platform. In fact, if you just observe, the first one is House of Tata, which is actually a thematic based portfolio, which is likely to do well in certain parts when the Tata Group companies are doing well. But this is not a broad based portfolio which you can use to generate long-term wealth, right? Next, I'll just take you through the managers page. Here on this, we are actually listed. On this page, you can see ST's portfolios on this specific page. You can just browse through all our portfolios, have a look at, go to their specific pages and have a look at their returns. So the max, this is actually including the back test. Since 2017, the results are also shared with you. But if you would like to look at just the live results, which you should actually, here are the returns. So over since May 2020, as I've informed earlier also, that we have been able to beat the benchmark by pretty good margin here, right? So you can just log on to this, go through our portfolios, and based on your risk profile, select these portfolios and subscribe to it. Yeah, that's it from our side. We are happy to take any questions if you have.
You're on mute, Pranav.
Thanks a lot, Vivek and Sandeep. What I have done from my side is to prepare a set of queries which generally tend to come through from users. And I would like to pose these questions to either one of you, and would maybe, I would like to take your inputs on this. So since Estee Advisors has been around for a long time, I wanted to understand from my end as to how your experience with your current investors has been so far.
Okay, Vivek, I should answer that.
Yeah, sure, Sandeep, go ahead.
Look, I think the investors come in many flavor, and I think this is a process in which we are doing a dual task. One is we are helping our investors understand how to invest, and second, we are helping them understand how to invest in a method that we are good at. So quantitative investment, systematic investment is a way of investing which is based on long-term research and empirical historical data. What happens is that when you are comparing results day by day, week by week, month by month, and you are trying to understand every single trade that you do, whether you're buying company one, company two, what is the reason why you are buying that, it's actually quite difficult to understand our methodology, which is based on long-term research and portfolio construction. So when we construct an overall portfolio, it works. But if you ask us, why did you pick this stock over that stock? Frankly, we are not going to be able to even answer you that. So our experience with the investor is there's a dual education that needs to happen. For many people, they are coming into stock market for the first time, so they need to understand what is that, how to invest in it. And then ones who are there but very active traders who try to trade on every piece of information stock by stock, understanding our methodology is one more step. So overall, I think it's great. We are firm believers in the methods that we have and the research that we do. And the process of education is the journey that we are on. And we want to make sure that people understand before they invest, and then they'll be able to see why this method can work over long terms in their benefit.
Got it. Understood. So we have covered, your investment philosophy. I wanted to understand from my end as to how you expect these small cases to perform, especially during turbulent market conditions.
Yeah, so I'll take that, maybe. So, Pranav, as I mentioned earlier during the presentation, that our portfolios have been able to do well even in last couple of months. That we have seen markets have been very erratic, and we have seen some correction, and they have come back almost now. So, as I shared with you, last 6 months markets have been down slightly, whereas we have been able to consistently beat the markets even in this market scenario, and that's what our expectation would be, that over a slightly medium to longer term, we would to be able to beat the markets and do well, all our portfolios. Having said that, uh, I believe in very short term, say 1 month or 3 month, even though we have done well even in those time frames, but that is something that we as investors want to should understand, that short term, the shorter term that you look, uh, the odds are not that much in your favor. So let's say if I pick any random day and see what is the likelihood of, say, a gear 6 portfolio beating the benchmark, it will just be slightly above 50%, around 51, 52% on any given day. But if you see slightly longer term, say 1 month, the chances of beating the benchmark by Gulaq Gear 6 increases to above 60%, right? If you have a look at, say, more longer term, which is around 6 month period, you'll see that the chances of Gear 6 beating the benchmark becomes 80%, and over a year it is close to 100%. So the idea behind this is, what I'm saying is that over very short term, we really don't know how we are going to perform. But if given a slightly medium to longer term view, which is 6 months to 1 year, we are very confident that we will be able to beat the benchmarks. And this is not only confidence, this is backed by data. And we have seen in last 2 years also that we have been live, or over a longer historical period that we have back tested, that we have been able to manage this volatility pretty well with our portfolios.
Right. So in that case, that brings me to the next question, which is, we have always noticed that the market conditions keep evolving, and sometimes newer conditions come through which we would not have experienced any time in the, maybe in the near past. So in such cases, I would like to maybe try to understand if you would change your underlying investment philosophy if the broader market conditions start changing.
So some part of the change in broader market condition is something that is systematically built into our methods. If you remember when I talked about how do we combine the micro strategies into a portfolio using regime estimators, I talked about depending on what is happening in the macro environment outside, we change what kind of a portfolio we are going to build. So some part of change in the macro environment, overall market is built into our process automatically. However, it is entirely possible that you get into a period where just none of the history is applicable anymore, something drastically different is happening. And we watch that very carefully. Um, we know that, and Vivek just covered it, that on day-to-day basis, the edge is very small. As has been famously said, that on a day-to-day basis, stock market is really a draw of luck. But over long term, systematic edge starts to show. So we measure what is the range of under or outperformance that should happen in 1 day, 1 week, 1 month. And at any time when we see that the performance that we are able to get is outside the range, what we call our cone of confidence, we have a certain confidence that this is the worst that can happen to our performance, this is the best that can happen to our performance. In 1 day, that's a very wide range. Sometimes we do much better than market, sometimes we do much worse than market. But over longer periods of time, our edge becomes more and more deterministic, more and more predictable. But we measure it at every time period. Now, if we find at a certain point that we are outside our cone of confidence, that means for some reason we are performing worse than what we had ever seen before, or for that matter, we are performing way more than something, then we know something has changed. History is no longer the way it needs to be. Then we'd have to rebuild, recalibrate our model, which we anyway do periodically. And then it brings into our process that new information. What is it that's different about the markets now? Maybe certain sectors have started to do very well in different types of environment. Maybe something else is happening in the way the economy is working that is not captured by our models. So two parts to the answer: regular changes, month on month, quarter on quarter, already built in. Systemic changes, things that have never happened before, now starting to happen, will come into the model automatically. The model is a learning model. It's a living thing that keeps recalibrating as it goes forward and keeps bringing in all that knowledge into how we are going to build the models.
Got it. So that brings me to my final question, which is, do you have any plans of launching new small cases in the future?
So, Pranav, our philosophy is pretty clear here. What we want to do is we want to simplify how a retail investor is currently investing. So obviously, I think we have the capability to launch many such products, but then we won't be doing our job of simplifying the things. Already there are so many products out there for each sector or each theme. So I don't think that makes the job of an investor really easy in identifying what one should be investing in. And that's where our philosophy comes from, that as I talked about earlier, that we have these 6 gears, which is a different asset allocation for different risk profile of customers. We believe that those 6 portfolios are kind of enough for all the investors, whether they are very experienced investors or just starting out their journey, whether the goals are, say, 2 years down the line or 20 years down the line. We believe these products, we have made it in such a fashion that they are likely to work uh, uh, consistently in the longer time frame. So we really don't believe that investors need anything apart from that. However, having said that, now there are few changes which are happening. Maybe tomorrow it becomes very easy for Indian investors to invest globally or in US stocks, or it becomes again regulatory clear that we can invest in, say, cryptos, and they are established as good asset class. We keep on analyzing that from time to time, and whenever we'll get that opportunity, we are going to analyze it, whether to include that within these portfolios or create another broader set of portfolios. We keep analyzing, but definitely not to take advantage of, say, short-term themes, right? We really do not believe they help investors build long-term wealth. So that
Right.
would be our answer.
Sure. All right. So I believe that there has been quite an informative session, and with that said, I would like to thank both the speakers who are with us today. That is Sandeep Tyagi and Vivek Sharma. So thanks a lot for sharing giving your time out and explaining the philosophy behind how you go about doing your investments. And for the audience who are here today, if you have any queries, feel free to reach out to the support at Angel Broking, and they will be able to get back to you promptly. So with that said, thanks to Angel Broking for hosting this session, and I'll talk to all of you soon. Thank you. Bye.
Thank you.
Thank you.